Chapter 14. So, chapter 13, here's why there's two different chapters on finance. Chapter 13 deals with mortgage loans on a one-by-one basis. You know, we're talking about how to calculate the interest on a mortgage loan. We're talking about how to calculate the principal and interest payment from a loan factor. We're talking about how foreclosure works. We're just talking about one loan at a time. Chapter 14 is talking about the mortgage lending industry. It's talking about loans in great big buckets of thousands at a time, and how the system works to keep money moving through and keep mortgage loans funded. So chapter 13 is one loan at a time. Chapter 14 is loan types, the broader mortgage market. All right? So we want to talk about the difference between the primary mortgage market and the secondary mortgage market. But before that, let's talk about the Federal Reserve System and what the Federal Reserve System is. The Federal Reserve System is basically it's the money manager for the country. The purpose of the Federal Reserve System is to keep stability in the monetary processes of the country. And they primarily do that through manipulation of interest rates. And the interest rate that they impact is the discount rate. The discount rate is the interest rate at which banks can borrow money directly from the federal government and from each other. And that's the interest rate that the Federal Reserve System can control. The Federal Reserve System doesn't set mortgage interest rates. They don't set credit card interest rates. But because they set the rate at which banks borrow money from each other and from the federal government, that rate impacts every other interest rate throughout the system. Does that make sense for you guys? Obviously, if the banks have to pay a higher rate to borrow money from each other, they pass that on to their consumers down the line. So when the Federal Reserve raises that discount rate, which is what it's called, it has the impact of almost every other consumer interest rate going up as well. Now, we've been in a period of time for the last several years since the financial fallout where the discount rate has literally been zero. It's kind of hard to go down from there.
Yep.
That banks have been able to borrow money from the federal government and from each other interest-free. Now, it is now at 1/2%. So they have raised it somewhat, but it's still historically at just historically low level, the discount rate. The goal of the Fed is to help counteract both inflation and deflation. Now, we do not want runaway either one of those.
Right.
Ideally, we would like some slow, steady inflation.
Right.
Any deflation is a bad thing. It sounds like a good thing, but it's not. Deflation means that things continually cost less. In other words, your money goes further tomorrow than it went today. The problem with deflationary trends is that people don't spend money. Because think about if you need a new TV and it's Halloween. What do? You go out and buy a new TV the next week?
Wait till Black Friday.
You wait till Black Friday, right? Because you know TVs are going to be what on Black Friday? Lower. In a deflationary market, people wait forever because they have this constant reluctance that if I buy it today, it's going to be worth less tomorrow. Does that make sense? And that has a cycling effect of causing prices to deflate even further. So deflation is very dangerous. Some small level of inflation is actually a good thing because it incentivizes people to invest now because it'll be worth more tomorrow. Does that make sense to you guys? Now, runaway inflation is not a good thing either. So the primary reason that the Federal Reserve System manipulates these interest rates is to control the flow of money, to control inflation and deflation, and keep us in a positive monetary setting. That's their goal. Yes, sir.
Am I wrong in thinking that the Fed is not a government agency?
The Federal Reserve System is what we call a quasi-governmental agency. They have, the banks themselves are federal agencies, but the governance of them is a combination of private banks and federal officers. So it's a quasi-governmental agency.
So the Federal Reserve itself is a quasi-government.
That is correct. That is correct. Okay? All right, and that's just a map of the Federal Reserve districts. We're in the 5th district. You don't need to know that. It just gives you an idea of what the Federal Reserve districts are. And by the way, if you look at your money, even though all money is minted at the Mint in Washington, D.C., it is drafted off of one of the Federal Reserve banks. It'll actually have that number code on there for the Federal Reserve Bank that bill is drafted off of. You know, if you look at any bill, it'll say Federal Reserve Bank of, and then that's the actual clearinghouse for that bank. Like this one, for example. Where is it on this new money? I can't find anything. St. Louis. This is the Federal Reserve Bank of St. Louis. So you know, every bill is actually drafted on a specific Federal Reserve Bank.
What does it mean when they say for this past 10 years that they've been printing money?
That they've been printing money? Basically, they've kept interest rates down so low that they've artificially depressed interest rates, which, you know, anytime low interest rates generally lend to a lot of movement of money. Because the lower interest rate, interest is a charge on money, right?
Right.
The higher the interest rate, the more expensive it is to move money around.
What it costs to sell money.
What it costs to sell money. When you've got low interest rates, it's very cheap to sell money, which means a lot of movement of money. And anytime you have a lot of movement of money, that tends to lead to inflationary trends. One of the fastest ways to stop inflation is to raise interest rates, because you slow down the flow of money, the movement of money, which can slow down inflationary trends. So when they say they're printing money, essentially what they mean is interest rates have been so low that there's just been tons of movement back and forth of, you know, monetary sources.
So they're not physically making money and throwing it into the economy?
No, it's not the actual act of printing bills. No, it's just the monetary system. All right. The Federal Reserve regulates the amount of member banks and how much they must have in their reserves. Like, for example, the federal district we're in would control Bank of America because they're headquartered in North Carolina. And so they would dictate how much money in reserve Bank of America has to have at all times. Those numbers are much higher than they were during the financial collapse. They're still shockingly low to me. At the height of the financial boom prior to the collapse, Bank of America's rate of capitalization was 0.5%. That meant for every $100 of deposits they owed out, if everybody had gone to the bank all at one time and tried to withdraw their money, for every $100 they had on deposit, they actually only had 50 cents in their possession. The rest of it was loaned out. That's what a capitalization rate means. It means how much money you have on hand at any given time. Now, right now, they're capitalized at about a 4% rate. That means for every $100 they've got loaned out, they got $4 actually on hand. That should make you feel they're 8 times as good, right? And it's not just them. The Federal Reserve sets those minimum levels. And so that's one of their main functions as well. We're going to talk about the Truth in Lending Act and Regulation Z later on, so I'm going to skip over that for a second. Okay? Talked about all that. The Treasury system is an extension in many ways of the Federal Reserve System, except the Treasury system supervises the actual banking activities. They are the regulatory body that controls what banks can do and what they can't do, is the actual Treasury system. And they also pay the interest that accrues on our debt, our national debt. So that goes through the Federal Treasury system. And we're going to talk later on about how they interact with the housing market. That's why we talk about them here. The Federal Treasury loans a lot of money to the various entities that purchase mortgages as well. That's one of the big money makers. When you get an FHA loan and you buy FHA mortgage insurance, you're paying it directly into the U.S. Treasury, because you're buying that insurance from the federal government. Okay? So let's talk about the differences between the primary mortgage market and the secondary mortgage market. The primary mortgage market is where the loans get made. That's where Scotty walks into SunTrust and says, I want to buy a house, I need a loan. That's the primary mortgage market. Primary mortgage market is where consumers deal with mortgage brokers or mortgage bankers and actually get their loan. Now I said they deal with either mortgage brokers or mortgage bankers. We also call them originators. Does anybody know the difference between a mortgage broker and a mortgage banker?
I'll take a stab at it.
Go for it.
The brokers are brokering somebody else's money, and the bankers are actually selling their own money.
That is a very good definition of the difference between the two. And so, say it another way would be, as a real estate broker, do I only sell my listings or can I sell anybody's listings? I can sell anybody's listings. So what do you think about a mortgage broker? They can sell anybody's what?
Money.
Money. Can a mortgage broker lend you BB&T's money?
Yes.
And can they lend you SunTrust money?
Yes.
And Bank of America's money?
Yes.
And Wells Fargo's money? If you go to Wells Fargo, that's a mortgage banker. Whose money are they lending you?
Wells Fargo.
Just Wells Fargo. Now here's the low down dirty truth. Sometimes a mortgage broker can lend you Wells Fargo's money cheaper than Wells Fargo can lend it to you themselves.
Surprise, surprise.
It's just the way it works. Because the mortgage brokers think of money as a commodity. It's hard to think of it that way, right? You know, but think of it as toothpaste. If you buy 10 cases of toothpaste, you probably don't get much of a discount. But if you buy 10,000 cases, do you get it at a cheaper price? Well, the mortgage brokers buy money from the banks in huge blocks. So they get lower rates from the banks than the banks are willing to give their own customers. Because here's the key. If I go to Wells Fargo and I borrow the money from them, who's got to check my credit? Wells Fargo does. Who's got to verify my income, verify my job, verify my tax returns?
Wells Fargo.
Wells Fargo does. Who's got to process all that paperwork? Wells Fargo does. If I go to a mortgage broker, who does all that work? The broker does, right? So Wells Fargo is willing to give that money to be loaned out at a lower interest rate because they don't have to cover the staffing that it takes. Does that make sense for you guys? Absolutely. So sometimes you will find, and I'm not knocking going to your bank, you should check all sources, but what I'm saying is, I have people all the time that will say to me, well, I've always banked with BB&T, so I'd like to get my loan from BB&T. I'm like, number one, BB&T's going to sell it as soon as they close it anyway, so it don't matter who you like to bank with, because they're going to sell it. Number two, you may go to a broker and still get BB&T money cheaper, and why BB&T's money is any different, I don't know, but, you know, you get it cheaper. You could conceivably get it cheaper than getting it directly from the bank themselves. But that's still all the primary mortgage market, because the key to that process is it's where the consumer is borrowing the money. Does that make sense for everybody?
Yes.
That is the definition of the primary mortgage market. So they're making the loans, they're also servicing the loans. Anything that involves contact with the consumer is considered the primary mortgage market. Where does the money come from? Everywhere. I mean, the money that gets loaned out in the primary mortgage market, banks traditionally get it from their deposits, right? It's money that's been deposited with the bank, and they turn around and they loan it out. There are all kinds of sources for money. Investment accounts, retirement accounts, all of those become sources. Insurance premiums. Y'all remember when the financial collapse happened, that the biggest company that didn't fail, that almost failed? You remember what company that was?
AIG.
AIG. AIG is the largest insurance company in the world. Why would an insurance company almost fail when the mortgage market was melting down? And it's not because they had a bunch of mortgage insurance out there. They didn't.
They owned a lot of real estate.
They didn't own the real estate.
They owned the money that was buying the real estate.
They owned the money that was being used to fund these mortgages. See, that's how insurance companies make their money. They take your premiums and they invest them in other vehicles that earn returns on your premiums, right? That's how you can pay $1,000 a year on a $500,000 insurance policy. Well, obviously, you ain't gonna live 500 years, you'll never pay in as much as you cash out, right? But they've invested your money all along, so they've made back that and then some, hopefully by the time you die. That's the way insurance works. Well, AIG almost failed because they had invested so much money in mortgages. So that's a big source of mortgage funds in the primary market. All right? Credit unions, obviously, is a source of primary lending. Pension funds, endowment funds, so like universities that have money donated to their endowments, they fund that into mortgages in a lot of cases. All right? Talked about that. The secondary mortgage market. This is not where loans are being made. This is not anything to do with the consumer. What's happening in the secondary mortgage market? Loans are being sold. They're being packaged together. They're being put in big buckets. They're being sold. Why would we do that? Why would a bank be interested in selling a mortgage loan?
So they can get money and do it again.
So they can get their money back, do it again. That's the very reason they do it. If we didn't have, and we learned this out of the Great Depression. Prior to the Great Depression, there really wasn't a secondary mortgage market. Banks loaned out the money they had on deposit. And one of the immediate problems that became apparent early on during the Great Depression, what triggered the Great Depression was the stock market collapse, right? And when the stock market collapsed, people needed to withdraw money from the banks to live off of. They had deposited money in their savings account, they needed to withdraw it. The banks didn't have it, because where was it? It had been loaned out. So then you got runs on the banks. And the banks had to call loans due not because somebody was behind on the payment, because they needed the money to give back to the depositor, right? So imagine if you owned a home or owned your family farm, and you get a call one day from the bank that says, you got to pay us all the money. Why? I've been paying you all along. Because we need the money back, we got to pay these people. That's what took us from a stock market collapse to a depression. Because the banking system collapsed. And the key there was the banks had no mechanism to sell those mortgages and replenish their money. So they had to call the loans due, which led to a collapse in the housing market. Does that make sense for you guys? So the secondary mortgage market was really created as a remedy to the Great Depression. Because think of it this way, and I know some of y'all are too young to remember this, but you old people among us like me will remember. Y'all remember the motels beside the side of the road that all had the same sign out at the highway? What was the one neon sign that every roadside motel had out there? Vacancy, and they had the word no, right? And, and when they were full, they would turn on the no, and when they weren't, they would. Every bank, if we didn't have the secondary mortgage market, every bank would have a sign out front that says money or no money. Money or no, because they couldn't make a loan if they didn't have enough money on deposit to lend it out, right? But with the secondary mortgage market, they can essentially churn the same money over and over and over. Because they make a loan, they sell it, they got the money back, they make another loan. Does that make sense? That's the purpose of the secondary mortgage market. It replenishes those funds so that we can keep making loans in the primary mortgage market. No discussion of the secondary mortgage market would be a decent one without starting at Fannie Mae. In your book, on page 308, it introduces Fannie Mae. First of all, that's not the real name of it. The real name of it is the Federal National Mortgage Association, FNMA. The Federal National Mortgage Association. This was created immediately after the Great Depression as part of the New Deal. And the idea behind Fannie Mae was to give a vehicle for investors to be able to pool together their money and buy mortgages. So the government created a private company. It's not a government entity, it's a private company. But it was created by the federal government. And here's what makes it a private company. It still is. You can go buy stock in Fannie Mae tomorrow. And that's where their funds come from. How does Fannie Mae buy mortgages? Well, they buy it with the proceeds from selling stock. That's the money that they use. They issue stock certificates just like any other company. The money that's invested through those stock certificates flows into the process of buying mortgages, and then they make money with the interest payments that are received off of those mortgages, right? And then they flip it over again and buy more mortgages. That's their business, to do nothing but buy mortgages. So the government created this entity, and it was designed to be a private entity. But there was a problem. The problem was this. What happens when nobody's got any money to invest? Then the well still runs dry anyway. It doesn't do much good to create this thing, which is designed to buy mortgages, if all the investors run out of money. Doesn't the business run out of money, and doesn't that put the brakes on the whole system again? So here's why we call Fannie Mae a quasi-governmental entity. When they run out of money, they are never really out of money. Because they're the only private company in this country that has a direct and unlimited line of credit to the United States Treasury. Fannie Mae can borrow as much money as they need to from the federal government anytime they need to. And that is the key to basically the way mortgages have been written in this country for the last 80 years, 70 years. Because Fannie Mae never runs out of money. If they never run out of money, they never stop doing what? They don't lend money. What do? Buying loans. And if they never stop buying loans, what do the banks never stop doing? Lending money. So you got to make sure you get that relationship right. Fannie Mae's not lending money. Fannie Mae's buying loans. And if they're buying loans, what are the banks doing? They're making loans. And if Fannie Mae never runs out of money, the banks never run out of money to lend, and you never run out of the ability to go get a mortgage loan. Well, we're talking about that. Because Fannie Mae doesn't want to buy a junk. She said, what's the mortgage insurance for then? Just because they have the ability to borrow money from the federal government doesn't mean they want these things to fail, right? This is a moneymaker for the federal government, folks. When Fannie Mae borrows money from the federal government, they pay it back with interest. And they have paid back. They borrowed, y'all want to hear this number? This is a staggering number. In 2008 and 2009, Fannie Mae kind of ran short of cash. They had to borrow a few dollars from the United States Treasury. 11 trillion of them. $11 trillion. A billion is 1,000 billion. A trillion is 1,000 billion. $11 trillion. They paid it all back. Plus interest. That's the beauty of that system. You can love it or hate it, but you have to admit, somebody knew what they were doing when they created a system that provides that much stability. Because even in the height of the mortgage meltdown in 2009, when property values were falling to the floor, if you had good credit and you had a job, you could get what? A loan. And that would have never happened if we didn't have Fannie Mae. If that system hadn't been created, because at that point in time, there was not a single private investor in this country who would touch a mortgage, what we call a mortgage-backed security, which is basically stock that's backed up by mortgages, right? You couldn't find anybody to invest in it. So the only place they could go for the money was the Treasury. And they did. Okay? So everybody got that? That's what makes them a quasi-governmental entity.
I just looked up their stock price. It went down to less than $1 in that fall.
It did, absolutely.
It ain't, we're about $4 now.
It's at $4 now, yeah. Yep.
And it was as high as 80.
Yes, prior to the collapse, because everybody and their brother was dumping money into mortgage-backed securities. All right? Now, Ginnie Mae which is also not the real name, the Government National Mortgage Association. This is the federal government's ugly, red-headed stepchild of Fannie Mae. But it's actually the one that benefits probably more people directly than Fannie Mae does. Fannie Mae is there to make money. I mean, anything that sells stock, a lot of people invest in a company of stock, make money, right? Fannie Mae's designed to make money. Well, because Fannie Mae's designed to make money, people who invest in Fannie Mae demand that it only buys quality loans. Does that make sense for you guys? I'm not buying stock in your company if you're going to buy a bunch of crap mortgages. I want you to buy the best mortgages, the ones that people are going to repay. Well, that's all well and good, but the federal government wanted more people to have access to mortgages. It created loan programs specifically targeted at giving more people access to mortgages. The two big ones are the FHA loan program and the VA loan program. Those were both created in the late 40s, early 50s. The problem was they were designed to give access to people to get mortgages who couldn't qualify for mortgages already. Maybe they didn't make enough money. Maybe they didn't have enough of a down payment. Maybe they didn't have the best credit in the world. Whatever the reasons were, these people didn't qualify for what we call a conventional mortgage. A conventional mortgage is one in which the government's not involved. That's Bank of America lending Bank of America's money. All right, that's a conventional mortgage. So these FHA loans and VA loans were created specifically for what was considered poor quality borrowers. Does that make sense for you guys? I'm not trying to label you if you have an FHA loan, by the way. I'm just telling you the realities of the system. It was designed by Congress to serve people who couldn't get access to loans. What do you think Fannie Mae said to these banks who were trying to write these FHA loans when they were trying to sell them to Fannie Mae? What do you think they said? We don't want them. Too risky. That person got no down payment, because really, remember Fannie Mae, I mean, for FHA, the main reason you do it is because you get a high loan-to-value ratio, right? You don't have to have much of a down payment. It's too risky, because traditionally, borrowers were expected to put down 20%. And here comes all these FHA borrowers putting down 3%. And Fannie Mae said, no, we're not buying that. Well, let me ask you a question. If you set up a system where banks can make loans and sell loans and get their money back instantly, what do banks do with loans they can't sell?
Bid them. Do they bid them out? Auction
What do
them,
they do?
whatever.
Hold them.
How about they don't make them at all?
Oh.
If they knew they couldn't sell it, they just refused to make them. So Congress created this VA loan and this FHA loan, and nobody was writing them. You couldn't find a lender in this country who would give you an FHA loan because Fannie Mae was telling them, we won't buy it from you. Yeah, you can make it if you want to, but you stuck with that one. You got it sitting on your books. Well, they were making money. They had seen the easy road with make loan, sell loan, make loan, sell loan, make loan, sell loan. We don't want to get back in the business of make loan and wait for a bad credit person to pay me back over the next 30 years. In marches Congress and creates Ginnie Mae, the Government National Mortgage Association. You want me to tell you what Ginnie Mae was designed to do? Buy the shit. That's its sole purpose from day one. Buy the crap that Ginnie Mae would not, that Fannie Mae would not buy. Buy it. And then sell it right to Fannie Mae. Here's the weird thing. Fannie Mae wouldn't buy it for the banks. They would buy it from Ginnie Mae. Wonder why?
It was government backed.
Say that again, Mark.
Government backed.
Because Ginnie Mae is the federal government. And when Ginnie Mae sold it to Fannie Mae, guess what they did with it? They guaranteed it. They insured it. Well, gosh, it's a different story now when you're trying to sell me something that's insured and guaranteed by the United States Treasury, right? Will you buy that loan if you're Fannie Mae? Absolutely. Ginnie Mae's not designed to hold loans. Ginnie Mae's designed to buy them long enough to stick a guarantee on them and turn around and sell them to who?
Fannie Mae.
Fannie Mae. So they all eventually go where?
Fannie Mae.
Fannie Mae. The question is, does Fannie Mae buy them directly from the bank, or do they buy them through Ginnie Mae? If they buy them directly through the bank, they're most likely what we call a conventional loan, meaning that the borrowers met these higher credit standards such that Fannie Mae feels comfortable buying those loans without a guarantee on them. Those are uninsured mortgages. That make sense? We feel good about these borrowers. We don't feel like they have to have insurance on their loans. These FHA folks, these VA folks, we'll buy them, but only if you put your guarantee on there first.
So Travis, I thought that banks were selling these mortgages to other banks or something. So how did my mortgage go from one bank to another? Like, why am I paying Bank of America now?
Because sometimes the servicing is different than, and remember the banks are also investing money on the back end in things like Fannie Mae. So the banks also invest in these things.
So Fannie Mae is really, Fannie Mae and Ginnie Mae, they're the only ones buying mortgages?
Not the only ones, but they're certainly the big purchasers of. Does everybody follow that now? Do you understand the purpose of Ginnie Mae? What is the purpose of Ginnie Mae? To make what?
Poor quality loans credible.
To make poor quality loans look like good quality loans, right? And the way you didn't make the loan itself better, you just put a cosigner behind it. It's not Kim by herself on the mortgage anymore. It's Kim and the United States government. They feel a lot better about that. Does that make sense? Now here's the thing. It ain't free. That insurance is not free. Ginnie Mae and the federal government are not doing this out of the goodness of their hearts. They charge for this insurance. And they charge a lot for this insurance. Government-backed mortgage insurance is the most expensive form of mortgage insurance. But again, remember, why are these people getting an FHA loan or a VA loan in the first place?
So they can't get it conventional.
Because they can't qualify for a conventional. That's the only reason. If you qualify for a conventional, there's no reason for you to get an FHA loan or a VA loan because it's always going to be worse terms. Always. Higher fees, the insurance is expensive. There's no reason to do it. I mean, why would a person who has really good credit go out and get one of those credit cards where you got to send them money to get a credit? Y'all know what I'm talking about? Like the secured credit cards or whatever those things are? The people that get those are people with what kind of credit? Bad credit. FHA loans, and I'm not saying you've got bad credit necessarily if you get an FHA loan. I'm just saying the only reason you would get an FHA loan is one of two and maybe both things. Either your credit's bad, you don't have a down payment, or both. Does that make sense? Because the standards are much lower than they are for conventional loans. You know, right now, conventional mortgage, you're looking at probably a 680 credit score. FHA, VA, you're looking at 620 as a minimum credit score. Conventional loan, you're looking at least 10% down, and sometimes higher. FHA, VA, FHA is 3.5% down, VA is 0 down. So, especially when you take the combination of the two, you got somebody putting 0 down with a 620 credit score, are they much more risky than somebody with a 680 credit score putting 10% down?
Yes.
Much more risky. Much more risky. And that's why it flows through Ginnie Mae, because they stamp that guarantee on there. They charge the borrower a mortgage insurance premium, and they put a guarantee on it. And that guarantee is backed up by the federal government. The full faith and credit of the United States federal government.
Is a mortgage premium a monthly fee, or is it thrown into the loan and amortized over 30 years?
Both. Both. In the case of the VA loan, it's up front. It's called a funding fee. In the case of the FHA loan, there is not an origination fee. There's an upfront mortgage premium that's one time, and then there's a monthly one in addition to that.
What is that, Norman? Do you have any
On
idea?
FHA right now, the upfront is 1.5% of the loan amount, and the monthly is 1.25% annualized. So, you know, basically it takes the effective interest rate from 4% to 5.25%.
Oh. So, okay, so it's actually financed, whatever the premium is.
No, it's not financed, it's just the equivalent of 1.25% of the loan amount. So, one way to think of it is your interest rate basically just went from 4 to 5.25 because you're paying 4% interest, but you're also paying 1.25% in your mortgage insurance premium.
I'm sorry, please, okay.
I'm just adding the two together.
I understand that. So what you're saying is that we're gonna pay that every month?
Yes,
Okay.
yep,
So it's not gonna be, it's $1,000 for the mortgage insurance and you just go ahead and pay that now and then we're not?
no,
So they're just raising your rate a point and a half or a point and a
that's
quarter?
exactly right. That's exactly right. The difference is when it gets passed through and sold from Ginnie Mae to Fannie Mae's only gonna buy it at the 4% interest rate. That 1 1/4 is gonna always stay with Ginnie Mae because that's the premium for the insurance policy.
Okay.
That's why it's stated separately like that. That makes sense now?
Yes, sir.
Yes.
And you'll pay that premium forever?
You aren't in this class. What are you asking?
I, you
Are
pay
you
that
gonna
premium?
pay that premium forever? That is a wonderful question. Yes. That is a change since the financial collapse.
Wow.
With government-backed loans, the mortgage insurance never goes away. I don't care how long you keep it, it never goes away.
Did it used to go
It
away?
used to go away,
80% or
absolutely. It
something?
used to go away once you had 22% equity in the property. But now, and you had an automatic date where it would fall off. Now, it's there forever. So if you get an FHA loan now, you will have mortgage insurance on it until you refinance it, pay it off, sell it, whatever.
So that's,
It's not, Ty said it's just a bad deal. It's not a bad deal when it's the only deal in town. I mean, you have to realize it is a wonderful deal for somebody who's got no choice, right? There's an old expression, in the land of the blind, the one-eyed man is king, right? And that's pretty much what an FHA-VA loan is. When you don't have another choice, and the choice is be a tenant or buy a house, FHA loans are great, because it is great by comparison.
And you can always like refinance, like when you get.
Yes, absolutely. When you get more equity built up in the property, when you improve your credit score, you can refinance into a conventional loan, which would have better terms. Okay, does everybody understand? Understand what Fannie Mae does, right? Fannie Mae is a private company that buys loans. And what kind of loans do they buy? Good quality, high quality loans. If they buy low quality loans, who do they buy them from? Ginnie Mae. And why are they willing to buy the low quality loans from Ginnie Mae? Because Ginnie Mae backs them up and guarantees them. Good. Good. And what makes Fannie Mae related to the federal government even though it's a private company? They can borrow money. Yep.
So in the situation you just described where a person with poor credit or whatever gets an FHA loan, they make their payments for 5 years and the market goes up 20%.
Yep.
Now they've got enough
Equity.
regardless of whether they have any cash, because the appraised value of their home should have increased.
That's right. But
You can't count on that.
and the mortgage insurance will not drop off. They would have to refinance to
Right.
realize that savings.
Right.
They'd have to go around refinancing to a conventional loan to actually realize that savings. There was a time when you could prove you had the equity and the mortgage insurance would fall away. And they don't allow that anymore. They still allow that in conventional loans that have mortgage insurance. There is mortgage insurance for conventional loans as well. Because anytime you have less than 20% equity, they're going to require you to have mortgage insurance. But mortgage insurance on conventional loans is traditionally much cheaper because, number one, you're still probably requiring somebody to put down like 10% versus 3%. And you have a better credit score, better income, but it's a better borrower. So it's usually cheaper for private mortgage insurance, and private mortgage insurance still falls off once you build to 20% equity. Okay? Freddie Mac is the basically non-existent one of these three now. Freddie Mac has been completely folded into the federal government because it collapsed. Freddie Mac was created to address the one black sheep that was left out of the mortgage process, which was credit unions. credit unions didn't have anywhere to sell their loans, because Fannie Mae wouldn't purchase them. They would only purchase loans made by banks. And so Freddie Mac was created to purchase mortgages from credit unions and savings and loans. During the collapse, it was proven that Fannie Mae was pretty smart in not buying loans from credit unions. There's a reason Freddie Mac collapsed completely. Credit unions tend to be a lot looser with their lending standards in some cases.
So now where do the credit unions?
Still Freddie Mac, but it's completely owned, operated, and subsidiary of the federal government. Yeah, it is completely folded into the federal government. You used to be able to buy stock in Freddie Mac as well, no more. It's not a publicly traded company anymore. Okay? Types of loans, we've already sort of mentioned this. The main categories of loans are conventional and government-backed. Conventional simply means not backed by the government. It doesn't mean they're not backed. There may indeed be mortgage insurance on a conventional loan, but it's not government mortgage insurance. The government-backed loans are not made by the federal government, they're backed up by the federal government. Don't confuse that. The United States government is not going to lend you money. You can't go up to D.C. and say, hey, I want to buy a house. It don't work that way. They will sell you mortgage insurance on a loan that you get through a private lender. So who makes FHA loans and VA loans? Anybody.
Originators.
Banks, any originator. Mortgage brokers, mortgage bankers, you can get them from anywhere. Absolutely. And USDA is the other one of those big three government-backed loans that we're going to talk about. Okay? Conventional mortgage loans generally have higher credit borrowers, like we've talked about, higher down payments, which means a lower loan-to-value ratio. You know, you make a higher down payment, you have a lower loan-to-value ratio. The magic number traditionally has been 80%. If you have a lower than 80% loan-to-value, you don't need mortgage insurance. If you borrow more than 80% loan-to-value, in other words, if you put down less than what?
20%.
20%, you need mortgage insurance until you've got 20% equity. Until you've got, and the mortgage insurance, this is an important thing to remember about mortgage insurance. Mortgage insurance does not cover the entire value of the mortgage. Think of it this way, and I'm going to draw you something here, hopefully will help. If you think of a mortgage like a bar chart here, and let's say this is 80% LTV, and here is the FHA line of 96.5% LTV. Let's see if I can get a different color here. Remember that the lender is perfectly okay, and Fannie Mae is perfectly okay with you all the way up to there. Right? If you're making a 20% down payment, or you're borrowing only 80% loan to value, what are they going to tell you about mortgage insurance?
Don't need it.
You don't need it. You don't need it. So that portion of the loan is always uninsured.
Okay.
Whether you have mortgage insurance or not, that portion of the loan is not counted in the mortgage insurance, because that portion of the loan, if that's all you were borrowing, they wouldn't require you to insure it at all. Does that make sense for you guys? So when you buy mortgage insurance, what you're really insuring is the difference between the 80% and whatever your loan to value really is. It's that gap. So in an FHA loan, it's the difference between 80% and 96.5%.
So it's gap insurance.
And why, it is like gap insurance, yeah, exactly. Why do you think traditionally lenders were okay with 80%? Where does that number come from? Think about their collateral. What is their collateral? the house, the property, right? Their thought process was this: there's no way we miss the value on this thing by more than 20%. So if worst comes to worst, and we have to do what?
Foreclosure.
Foreclose. If we've only loaned out 80% of the value of the property, we should always be able to do what?
Get our money back.
Recoup our costs.
Get our money back.
And some.
Well, remember, they can't keep the and some. They get their money back. Does that make sense for you guys? That's why they don't require you to have mortgage insurance if you're only borrowing 80%, because they feel very secure that the collateral will always cover them. But as you get above 80%, they get more and more concerned that if we had to foreclose, well, you think about it. How much is a real estate commission?
6%.
6%. So if somebody takes out an FHA loan and their house doesn't go up in value and they get foreclosed on after a year, that loan's already underwater just with the real estate commissions when they try to sell it, right?
Yep.
Not counting the attorney's fees, not counting all those other fees that get tacked on, but just the real estate commission already puts them underwater. Yep.
Insurance. Is it always Judy that collects it? Because
No.
there's not an insurance company that does mortgage insurance, right? Like, say-
Sure, there's more, but not government mortgage insurance.
Okay, so like a
Private.
commercial loan,
Would have private mortgage insurance.
Nationwide or somebody.
Well, not nationwide,
Okay.
AIG.
Okay.
It's probably expensive.
It's actually cheaper than government mortgage insurance
Really?
because they're better quality borrowers. And they're insuring less of a gap. Because remember, with a conventional borrower, they're probably putting down at least 10%. So the gap they're insuring is only from 80 to 90% versus from 80 to, and so what is the gap on a VA loan? From 80 all the way up to 100. People ask me all the time, why are the funding fees on a VA loan higher than they are on FHA? Because it's riskier. Isn't 100% loan to value riskier than 96.5% loan to value?
Yes.
Absolutely it is.
But I can see why somebody who is eligible for a VA loan would think that that's what they're supposed to get. I mean,
You can see how somebody would think they should get better than what they get. That's amazing right there. That's what you just said to
No,
me.
what I'm trying to say is, because I don't think of it as a, how do we characterize FHA and VA? Because if I was a veteran, I would think that that's just what I'm supposed to get, you know?
This is who you talking about.
Yeah.
Do I care about the veteran?
Easy now.
Well, I mean, honestly, if I'm the banker, what do they care about?
Money.
The money and repayment of the loan. They look at it as simply a matter of risk. The banks will tell you, we love the VA loan program. You know why they love it? Because the federal government's willing to take on that risk. But the federal government's going to charge. Now, you could make an argument that the federal government should be willing to take on that risk at a cheaper price. That might be your argument. But your argument's not with the banks in that case. As much as I hate the banks, and I do, trust me. I mean, most of them are evil to their sorry. They just are.
I'll second
It
that.
is what it is, you know.
You're probably the best one of them.
Well,
we got the best one, haven't we?
there's a certain, the devil is Bank of America. We all know that, right? I mean, I'll never be their spokesman. You don't have to worry about
I
that.
don't know.
The fees.
But they, you know, the banks just don't care about that. They care about risk. And ultimately, the investors who are buying these mortgage-backed securities care about risk. So the riskier the loan is, the more expensive the mortgage insurance is going to be. Does that make sense for everybody? So we can have insured or uninsured conventional loans. Generally speaking, if they have a loan-to-value ratio of less than 80%, they're going to be uninsured. If it's more than 80%, they're going to be insured.
So Fannie Mae is buying most of those bundled mortgages. You know what percentage?
I'm sorry,
You know what percentage?
of conventional loans?
Of whatever they're buying, of all the mortgages.
Right now, Fannie Mae is buying about 95% of all mortgage products.
Is that all, it's been the case for quite some time, or just recently?
Well, during the height of the boom, a lot of companies were buying mortgage-backed securities directly. They were actually directly negotiating with, like AIG,
Right.
you know, had a couple, $100 billion worth of mortgage-backed securities, and they weren't buying them through Fannie Mae. They were buying them directly. They actually owned the securities. So Fannie Mae was competing with them to buy them. Now, Fannie Mae's not competing with anybody. They're just buying them. And so it's a very skewed reality right now. And that's because the yield's so low. Remember, the yield on a loan is the interest rate, right? Look at a private investor. Why would AIG want to go out and buy a bunch of mortgage-backed securities at 4% interest rates? They don't want that.
Right.
But in 2006, when those things had, because think about, remember what I said about how you create a bubble. You qualify worse and worse borrowers, right?
Right.
Well, what kind of interest rates do you give those worse borrowers?
High.
High interest rates. So what happens to the yield of those mortgage-backed securities that you're selling?
It goes up
It goes-
astronomically.
It goes up astronomically, and so these companies that are like AIG, that are looking to invest their money, all this cash they got sitting around, they're looking over here and they go, mortgages, man, we can get a 10% return buying mortgages. So they bought all they could get and then some. They just wallowed in it, just fell in it and all they could get and then some. Because the idea was they could never fail because they never had.
Right.
It was like free money to them on their spreadsheets because their chance of loss was literally zero. You looked at their spreadsheets and they said their chance of loss was zero because mortgage-backed securities have never failed. That was the thought process. Then you get into what was really happening with the mortgage-backed securities, and if you've never read The Big Short, you probably should. It's very enlightening reading. I'll just give you a hint of what was going on. So mortgage-backed securities are usually thousands of mortgages that have been packaged together, right? But they're not identical. A certain percentage of them are really, really, really good mortgages, and then a certain percentage of them are not so good mortgages, and they call those tranches, and they're like levels within the pyramid. And as you go up the pyramid, they get riskier. But the idea is that you only got a few of the bad ones up here at the top, and the vast majority is really solid ones down here at the bottom, right? Well, the ratings agencies that rated how good the quality was of these things, so that when you were buying it, you know, if you buy something that's AAA, that never fails. Never has, never will. That's the way it was thought of. You know, you couldn't possibly lose your money if you invested in AAA. Well, the way the rating agencies had always rated mortgage-backed securities was, you just give us a random sample of 1,000 mortgages, and we assume that 80% of them are of the highest quality, because that's what they've always been. And only 10% of them were junk. Everybody follow me on that, right? So you had 80% that were unbeatable, made of solid titanium, cannot fail. And 10% up here at the top were, but that risk was spread out amongst all these 1,000 because you're buying all 1,000 of them at one time. The banks figured out that they could take the really bad, the ones that they had never written before, they were so ugly, and they could put them all in one mortgage-backed security. Because what did I say the rule was? For any 1,000 randomly selected mortgages, 80% of them must be what?
AAA.
Must be fantastic,
AAA.
except all of them were what?
Junk.
Shit. Every single one of them. But because the rating agencies had an outdated system, they didn't even look at them. They just said, oh, that looks like a mortgage tranche to me, it's AAA. And then AIG comes and buys it for a couple $2 billion. Well, if that works one time for the bank, guess what? They do it again. And guess what? It got worse from there. Because they kept taking progressively the worst ones that couldn't get sold off the top, and they would build a whole mortgage-backed security out of the absolute worst, the ones that couldn't make it in the first 3-4 passes, and even that got rated AAA. So you were investing, and so here's what happened, to answer your question about why everybody was buying mortgage-backed securities. Because mortgage-backed securities that were AAA rated had always had a really low return. Because can't lose gets low return, right? Think about when you deposit money in your savings account at the bank. That's a can't lose investment. What does the interest rate look like?
Crap.
Terrible, right? 1%. Well, mortgage-backed securities had always been can't-lose investments if they were rated AAA. Now, all of a sudden, a can't-lose AAA-rated mortgage-backed security could be bought with a 12% yield. What does a company do with their money when they see that?
Buy it.
Please take our money. All of it. And when you flood the banks with money from buying mortgages, what do they do with that money?
Lend it.
They landed again.
They make more loans. And who do they make those loans to?
More poor.
Anybody.
The people they couldn't qualify last time with the crappy guidelines, so what did they have to do with their guidelines again?
Adjust.
Lower them one more time. That is what we had.
So the banks actually were the culprit. I mean, what
Question.
I saw happen at that time was that
Unquestionably.
people were financing their poor buying habits with their equities.
Absolutely, with their fake equity.
Yeah, well, and then that equity those chickens came home to
And
roost.
the blame is everybody.
I
It's
know.
the banks, it's the mortgage brokers, it's the real estate brokers, it's the consumers themselves.
Absolutely.
It is everybody across the spectrum who we whistled past the graveyard, you know? Everybody just walked around like that was normal. I mean, I had a friend who was drafted by the Chicago Cubs, and he took his entire signing bonus, and he bought houses in Arizona, new construction houses. And he got $1 million signing bonus. He bought, and here's how he got the idea to do this. He bought himself a house in Arizona because they have spring training out there. The Cubs have spring training out there. They surprised Arizona, so they wanted a house. He was supposed to close on it, and he was doing the final walkthrough, and somebody pulled up on the curb and said, we'd like to buy your house. He said, well, it's not even mine yet. He said, that's all right, we want to buy it anyway. They offered him $50,000 more than he was paying for the house. He owned it for a week, and he sold it. What do you think he did?
Bought another one.
Not one,
Bought several.
5. And it worked for a while. When the market collapsed, he ended up with 6 houses. And he had $3 million worth of debt. The houses were worth $1.5 million. That's what happened. And it happened thousands and thousands, millions of times, over and over and over, because the market was so artificially inflated. That's what a bubble looks like. And once you kind of understand how the secondary mortgage market works, you understand how it can happen, right? Does that sort of make sense a little bit for you? Good. Sorry to get off topic, but you need to know. All right, we've already talked about loan-to-value ratio, but I want to add a wrinkle to it for you. I want to give you a wrinkle on loan-to-value ratio. Every time we've done it so far, we've done it as a percentage of what?
Purchase.
Purchase price. There's a wrinkle there. It's a percentage of either the purchase price or the appraised value, whichever one is lower. So if they give you a test question and they give you both the sales price and an appraised value, which one are you going to use to calculate the loan-to-value
The
ratio?
lower of the two.
The lower of the two. This is what we mean when we say a property doesn't appraise. The lender's not going to lend on that amount above the appraised amount. So you would have to bring that amount in cash out of your pocket, right? Think of it this way. If you were doing a 10% down payment, you're doing 90% loan to value, and you agree to pay $200,000 for the house, what would your down payment be there?
20%?
20 grand, right? 10%
Yeah.
down payment is $20,000. What if the house only appraises for $190,000?
Gotta bring it
If the
back.
house only appraises for $190,000, they're only going to lend 90% of $190,000. So you'd have to calculate what that is, and then you'd have to subtract that number from the $200,000 to get what their down payment would be. Does that make sense for you guys? Can you work that out?
That could be happening a lot in this market where
It happens
things are
every
getting
single day
bidded
right
up.
now. Every single day, because the way prices are going up in our marketplace. Yeah, very
If
common.
you've had multiple appraisals, how do you know?
You can't.
Okay.
That's one of the financial reforms that came out of the market collapse. It's a really good question. She said, what if you have multiple appraisals? Well, that's exactly what would happen. In fact, the lenders would contact the appraiser, and they would say, you know, we're writing a loan on 123 Main Street, and they're trying to get $450,000. We need an appraisal for $450,000. You think you can do that for us? And if the appraiser said no, they said, okay, well, we'll find somebody else. They gave the appraiser the number and said, you can have the job if you'll appraise it for this number. So one of the reforms that came out of that is the lenders are no longer allowed to talk to the appraisers at all. They're not allowed to choose the appraisers. They have to go through a lottery system, and it's automatically, randomly selected. And that has its own downfalls. Every well-intentioned reform, you know, there are a lot of negative things that have come from that process too. Sometimes we get appraisers from Greenville up here appraising in Chapel Hill, and I want to beat them with my shoe because they don't know what they're doing.
What do you do in that instance if you do have someone that you feel like is misappraised?
You're stuck.
There's nothing you can do?
You're stuck.
There's no appeal.
Because they firewalled off the appraisal from everybody else. We're not allowed, there was a time when if the appraisal came back bad, I could call and make a case. I could say, listen, you used ridiculous comps, you missed this comp, it's the best comp, you need to, and they might change it. I can't talk to them now. I'm committing a felony if I call them and try to get them to change that. Now what I can do is meet them there when they do the appraisal and make sure
They see it.
that they've seen my comps, they've seen my CMA, so they don't miss something that I thought was important, so at least I can kind of make my argument ahead of time, I just can't disagree with them after the fact.
What if you're working with a seller and they say, okay, well, let's take it off the market for 30 days because I don't think that's good. Could you do that? And then they
You
would,
could for conventional purposes, but FHA and VA appraisals last for 6 months. Whether they were done for you or some other borrower. Once that appraisal is locked in on that property, that is the appraisal for the next 6 months. So it's definitely walled off big time now. Alright? Conforming loans. The idea of conforming versus non-conforming. Okay? Basically, a conforming loan is one that's below a certain limit in most cases. FHA has guidelines for every zip code in the country about median housing value, and Fannie Mae uses those guidelines and says we will only buy mortgages up to this percentage of median housing value, and it's usually 200% of the median housing value. So in other words, Fannie Mae will only buy a mortgage that's double the median housing value in your area. They don't want to be in the luxury loan market. That's not what they want to be in. So we call those conforming loans. In Wake County, that number is $417,000.
Is the median?
I'm sorry?
You saying that's the median?
No, I'm saying that's double the median.
Okay.
That's double the median. That is the conforming loan amount in Wake County, is $417,000. So what I'm saying is Fannie Mae will buy mortgages up to that amount. We call those conforming loans. How many of you have ever heard the phrase a jumbo loan? A jumbo loan is anything above the conforming amount. Generally speaking, they're going to have higher interest rates because they can't be sold to who?
Fannie Mae.
Fannie Mae. If the bank can't sell them to Fannie Mae, it's harder for them to get their money back, so they charge a higher interest rate to make it more attractive to sell to somebody else. So a lot of times what you would see in that case would be two loans. You would see a $417,000 conforming loan and then a smaller second mortgage for the difference at a higher rate. But the higher rate would only be on the smaller second loan.
So you said the jumbo loan what?
Jumbo loan is too big for Fannie Mae to buy it. The other type of non-conforming loans are what we call the subprime loans. Subprime loans are also non-conforming. Those are ones that are below the FHA guidelines. And Fannie Mae says they won't buy them. They bought a lot of them during, they didn't know they were buying them.
What does subprime mean in that?
Subprime means below minimum FHA qualification standards.
Doesn't have anything to do with prime interest
Doesn't
rate.
have anything to do with prime interest rates. It's just that anybody, the idea is that anybody who meets the minimum FHA requirements, their loan can be sold as a prime loan because it can go through the government insurance portion, or it could be just a straight up conventional loan and be sold directly to Fannie Mae. So basically anything Fannie Mae will buy is considered a prime loan. Anything that Fannie Mae will not buy is considered a subprime loan. Okay. Private mortgage insurance, this is going to be on conventional loans. Remember, conventional just means it's not backed by the federal government. That's all it means. It doesn't have any special meaning other than that. It could still have mortgage insurance. It just means that mortgage insurance would be private mortgage insurance. All right?
These guys go away?
and it does go away. Private mortgage insurance goes away once you build 22% equity in the home. And you can do that in one of two ways. There's either a scheduled date when you pay down the mortgage to that point where it falls off, or if the home goes up in value or you pay your mortgage down faster or whatever, you can solicit for them to drop it off. You basically have to pay for an appraisal and prove that you have that equity, and then the private mortgage insurance would fall off. But it does fall off. Okay? FHA loans. We have talked a lot about them, so we shouldn't have to spend too much time here. FHA is a federal loan program that simply allows a low down payment of how much? What's the FHA down payment?
3.5.
3.5%, and a lower credit score borrower to qualify. Now, it doesn't mean that the interest rates are higher on FHA loans. They're not. The fees are higher. It's the fees that are higher. The government does not make these loans. They simply insure them. They're always fixed rate loans. They're generally always 30-year terms, so you can do a 15-year FHA. They require you to live in the property. You cannot do an FHA loan on an investment property. And that maximum loan amount is the amount we talked about, that conforming amount. Here it's $417,000. And that'll probably change when the census comes around in 2020. Yes?
So the stipulation of you having to live in the home, is that for the entirety of the loan, or can you?
That's what it says.
Okay.
What it says. What I will tell you in practical purposes is that as long as you make the payment, ain't nobody gonna come check. I would say that there's a significant number of investment properties out there that have FHA loans on them, because as long as they're making that payment, nobody's really gonna come verify that it's an owner occupant. But technically, yes, you're supposed to remain an owner occupant. Okay? The interest rates are set by the lender, not by FHA. It must be appraised by an FHA approved appraiser. There can't be any prepayment penalties, and they must be assumable. Okay? It used to be the case that they were assumable without the buyer even qualifying. So you could assume, anybody could assume one. Now, and for the last almost 30 years, the borrower has to qualify as if they were getting a new FHA loan at the time. So they still have to be qualified to assume it. The VA loan program, this is a government-backed loan program in which the government allows veterans and their qualifying spouses to make no down payment. Two significant differences here between the VA loan and the FHA loan, and they're really the only two differences. Number one, we allow for 100% loan-to-value ratio. Okay? In other words, no down payment is required. Number two, that the FHA fees have to be paid by the borrower up front. The VA fees can be rolled into the loan. So they will actually not only let you not make a down payment, they will let you also roll all of your closing costs, that VA funding fee, into the loan as well. So it truly is a no money down purchase. And in this case, the VA is guaranteeing that portion of the loan amount.
So there's a good chance they start out upside down.
They always start out upside down for the first many years.
Unless they happen to get a bargain.
Unless they, yeah, right. Unless they happen to get a steal, but most likely they're upside down for 5, 6, 7 years, best case scenario, on a VA loan. Yes. And they do some things, you know, like if they have a service-related disability, for example, they waive the funding fee. Now that becomes a really good deal for somebody because you're getting 100% loan to value with essentially no mortgage insurance. So that's a big deal.
Is that on a certain percentage of disability or?
Yeah, it's based on your percentage of, what percentage your service-related disability is, and they got formulas for everything.
Yeah.
Okay? It can be assumed by anyone. You do not have to have, a VA entitlement in order to assume it. Anybody can assume a VA loan. The key here is, though, that the entitlement is tied up. The veteran can't go out and get another VA loan until that one's paid off. Does that make sense for you guys? All right? So if a veteran allows their VA loan to be assumed, they're basically giving up the right to get another one until that loan's paid off. All right?
I have a question.
Yep.
If you have, say you have a VA loan and you want to you want to sell, can you sell, when that buyer purchases that VA loan and assumes whatever loan you have, can they then refinance it to be something other than a VA loan, or does it have to stay that?
Oh, no, they can refinance it, of course.
And at that time, does that release the entitlement?
It does, absolutely. Anytime the loan's paid off for any reason.
Okay.
Yep. All right? The most common FHA loan program, and that's all you need to know about it, is the 203B. That's the most common. Most of the time when somebody's getting an FHA loan, they're getting a 203B loan. They have a 203K, which is the rehab loan. They have several different ones, but the one you might see on a test that they make specific reference to is the 203B loan program, which is just a standard FHA loan. You can get gifts from a relative or some nonprofit entity for your closing costs and for your down payment. But you have to give them a letter swearing that it's a gift and you're not going to repay it.
But if it's given as a gift, do they get to write it off of their taxes?
I don't know, that's a tax question. I have no idea.
Oh.
Okay? You don't need to know these other programs. The last of the government-backed loans is the USDA loan. The USDA loan, and yes, it's the United States Department of Agriculture, of all people, making mortgage loans. And in this case, they are actually lending the money in some instances. This is unlike the FHA and VA loan programs. They don't like to. They prefer to have the banks lend the money and they just provide the mortgage insurance. But in some isolated cases, and isolated is the key word here, if somebody's so far away from something that they can't even get to a lender, then the USDA will lend them money directly. If you're in North Dakota somewhere out in the boondocks, you can get a USDA loan and they will lend you the money directly if you're too far away from a lender. These are what we call rural development loans. So not only does the borrower have to qualify, the property also has to qualify. They will only make this loan in certain areas. You have to go on the USDA website and search the address to see if it's in an eligible area. The USDA loan's advantage, 100% loan to value. They don't have to have a down payment. If somebody's making a down payment, there's no reason for them to do a USDA loan. What should they do? If they got a 4% down payment, what should they just do?
FHA.
FHA, because the FHA doesn't have this restriction about only available for certain properties. This is designed to help develop rural areas, to incentivize people to purchase homes maybe a little bit further out. There are still some very isolated pockets of Wake County that qualify for USDA financing. That will go away in 2020 at the next census. It should have already gone away at the last census, but because the housing market was just starting to recover, they agreed to basically not redraw the maps after the last census because it's based on population density. Once your population gets to a certain point in a certain area, it's no longer considered you need development of that area. So right now, everything off of Rock Quarry Road, 27610, basically, is in a USDA eligible area. And if you've been down there, that is certainly not a rural area.
No.
But that's because the last maps were drawn in 2000, because the 2010 maps they ignored. And so that area still qualifies for USDA financing. That is not an area to buy in if you're making an investment right now. Because what's going to happen to pricing in that area when the 100% financing goes away? It's going to drop. Because fewer people are going to be able to buy there. All of a sudden you go from not having to make a down payment in those neighborhoods to you've got to have a down payment. That will certainly have, it won't be a long-term impact on pricing. It'll probably take a couple of years to wash out. But, you know, if I was going to buy in there, I would wait to buy it until 2020. Buy it when it drops, and then wait for it to come back. Because it will. Okay? Alright, it's restricted to low-income residents of rural areas. It's also the only loan where there's a maximum income. You know, normally we think of loans as having a minimum income level, and it does, but it also has a maximum. So you have to make between this amount and this amount, and you have to be in an area where the property qualifies in order to qualify for one of these loans. I know this chapter's a slog. We're almost there. I promise. It's tough. Told you that. And it's heavily tested. And trust me, this is about the most interesting anybody can teach it, too. I've seen much worse.
You said this part's heavily tested?
Yes. This whole chapter 13 and 14. It is. How the money works. That's right. All right, so some different types of loans are kind of special purpose loans. You just need to know what these are. These are the official names for loans that you probably already understand at least a little bit, but you just never knew what they were called. This first one, who knows what a purchase money mortgage is? All of you do. It's seller financing. Seller financing is a purchase money mortgage. So they'll use that interchangeably on a test. A lot of times they'll say it like this: the seller agrees to take back a $30,000 purchase money mortgage. What that means is they're financing $30,000 of the purchase. Okay? Everybody got that? Purchase money just means seller finance. The other one you ought to pay attention to down here is a package loan. A package loan usually includes real property and personal property. That's not very common. A blanket loan is common for developers. Here's the key concept to a blanket loan. It's attached to multiple pieces of property, and you can individually pay off little parts of the loan and have the lien removed from individual pieces of property. Who would want to do something like that?
A developer.
A builder. As they sell a lot, they want to remove the lien from just that one lot. So they don't want to have a loan on each individual property. They have one blanket mortgage that covers the whole subdivision, and they pay off individual little pieces of it. Make sense? Yep.
So in a situation like at a university where they have multiple buildings, but they're all like, I guess, considered one property or a piece of real estate, how would this be the type of loan situation that they would set up if they were
Shouldn't
going to?
have a loan unless it's a for-profit.
Right. Oh, because they should be pushing out an endowment.
I'm sorry?
Because they should be operating off of an
Well,
endowment.
I mean, if they're a not-for-profit, they should have all their facilities be paid for through an endowment or borrowing against an endowment, not actual liens, because most of the time they don't have the ability to place liens on the land because the land is owned by the state, for example.
So what if like a University of Phoenix actual
Oh, I don't know
site?
what those people do.
Yeah,
Who knows?
you know, I'm
Take your money, that's what they do. Okay? Construction loans, here's what you need to know about a construction loan. the most risky type of residential loan. And here's why. What collateral do they have?
Land.
The ability of the builder to get it done.
The builder to get it done, right? Because essentially they're lending money before the thing is even there. If that goes south, that's a pretty big risk they just took. Yeah, they can take the land, but they've probably loaned a lot more than the value of the land, right? So construction loans are definitely the most risky type of residential loans. That's why they're very hard to get. Okay? Sale and leaseback, that's exactly what it sounds like. The seller is going to lease the property back for a certain amount of time. Builders do this all the time with their model homes. How many of you ever been to a model home? The builder doesn't own it. They've already sold it. It was the first house in the neighborhood they sold. And they just signed a long-term lease on it to lease it back. You know why they do that? They don't want $300,000 tied up in that house for 4 years. They'd rather build it, sell it, lease it back. And an investor loves that because they're buying the nicest house in the neighborhood because it's got all the fancy upgrades, right? They usually sell it to them at a discount. And then they've got a constant cash flow for the first 3 years. And the investor comes in when the builder's done, they sell it. I love it. You'll see that a lot when you see one for sale. Former model home. That's the investor who bought it and has leased it back. And then, Monty, you asked about reverse mortgages
Yeah.
the other night. That, a reverse annuity mortgage, that's what we're talking about. So how many of y'all are familiar with reverse mortgages or the idea behind a reverse mortgage?
Seen it on TV, that's it.
You see them on television. You see, used to be a congressman from Tennessee, dead now, Fred, whatever his name is. Fred Thompson, right? He's dead, right?
Oh, I know.
Yeah?
Yeah.
He's always up there with them. And who else tells them all the time? It's not Alistair Beck, that's Colonial Penn. Oh, the Fonz, that's right, the Fonz does the reverse mortgages now. These people don't know who that is either.
I do.
They're making a comeback with older, like 62 and up.
What now?
They're making a comeback.
Who's making a comeback?
The reverse mortgage.
The reverse mortgages, and this is who they're designed for. They're designed for older people.
Yeah.
So here's what a reverse annuity mortgage is. A reverse annuity mortgage reverses the whole idea of a mortgage. Generally speaking, you borrow money in a big lump sum, and you pay it back in small increments, right? That's a mortgage loan. A reverse annuity mortgage is you borrow the money in small increments, and you don't pay it back until you're dead. That's the idea. Or until you ain't got no more equity to tap in that property. It's a structured loan that you're taking out on a monthly basis. People do it when they can't afford their living expenses. And they have this equity tied up in their home, so they draw it down month by month.
They're just making their equity liquid.
That is correct. It is a way to liquidate their equity in small little chunks. And usually these things are set up that they'll only lend out up to like 70% of the value of the property. And at that point in time, you have to look at the way the thing's structured, because some of them are structured to say they have to vacate the property at that point in time. Some of them are structured to say that they can remain in the property, they just won't get any more payments. You know, so there's a big difference in how they're structured. And before somebody signs on for one, it's essentially you're making a bet how long you're going to live. You know, because you go into it and you know you're going to get payments for this many years, and you're sort of thinking, am I going to die before that, or am I going to be in a nursing home? You hate to make it in those terms, but that's kind of what you're doing.
It's good too if you don't have any sibling kids, you know, or anything to leave anything to.
Right, yeah, because it certainly is great for people who can't afford their living expenses, because it gives them a structured income on a
And they
monthly
get to stay in
basis.
their house.
And they get to stay in their house during that time. That's right. We talked about purchase money mortgages being owner financing. That's what you really need to know, and that's all you need to know about them. Okay? We'll run through these because I already talked about them. We talked about a buy down. Usually builders do this. Home equity loans or HELOCs. A home equity line of credit, that's what HELOC stands for. This is when you go and you take out a small mortgage against the equity you have in your property. And it could be a standalone, or it could be a second mortgage, or even a third mortgage. and you're borrowing against the equity. The difference in a home equity line and a mortgage is a standard mortgage, again, you borrow in one lump sum. A home equity line is usually a line of credit, so you can borrow a little or a lot or all of it all at once or in tiny bits. They just give you a checkbook, and that checkbook has a credit limit. But whatever you write that check for, that's what you're borrowing against the equity of your property. And yes, these are sometimes used in purchases too. I have seen people get an 80% conventional loan, put 10% down, and do a 10% home equity line of credit. You can structure things like that. All right, talked about reverse annuity. As far as mortgage priority, we just talk about words like first and second. That's what they mean, the order they get paid in. The first mortgage is the first one recorded, that's the first one to get paid. Second recorded, the second one to get paid. It doesn't matter which one's the bigger one, it simply matters which one was recorded first. Okay? And then the last thing you need to know on page 321 is this idea of a subordination agreement. A subordination agreement just means that the first mortgage is agreeing to get in line behind the second mortgage. They don't often do this, but so this might happen. For example, let's say you're refinancing your house and you've got a home equity line that you're not going to close out. Well, when you refinance, your home equity line was your second mortgage, right? Because you had a primary mortgage and then you went and got the home equity line. When you refinance, what are you doing with your primary mortgage? You're paying it off, right? And you're taking out a new mortgage in its place. But now, which was recorded first? The home equity line or the primary mortgage? The home equity line was recorded first, right? And so that means they sit in line first. Your other lender's not going to like that. So they're going to require them to sign a subordination agreement and say, we agree to be paid after.
Well, why would the previous lender let you maintain your line of credit in that scenario?
They don't have to. They could choose to close it. So they're going to make that decision ultimately. Because basically what you're going to say to them is, listen, either you take the subordination agreement or I'm going to have to close out my line of credit completely. So they make that choice.